thank you very much for joining us, and a very warm welcome to our guest today to talk about a public finance topic, but a slightly different. There's a bit of echo here. I think if you can. Let's see if it's now. Is it better now? I think the echo is gone, yeah. Okay, so thank you for joining us for this public finance topic. We work a lot on public finance issues here at Bruegel, but this time with a slightly different slant, and I think it's an important slant, and thank you, Francesco, for thinking to put this on the agenda. It's about the quality of finances now, not just the quantities of finances where we typically try to monitor, but this time we want to talk also about the quality of finances and what we can do with that to improve both the effects but also the sustainability of finances. I think these are the two big things. And I have a very prestigious panel here. Thank you for coming. I'll introduce you, Boris Cournede, here on my right from the OECD, who is going to give us an introductory presentation for about 20 minutes to set the scene, followed by some discussions with Sven Langedijk from ECFIN in the European Commission, and Francesco Papadia, who is a senior fellow here at Bruegel. So without further ado, Boris, why don't I give you the floor and 20 minutes for the presentation. Thank you.
Thank you very much. I am very pleased to be here. Many thanks to the organizers for the kind invitation. So I'm going to present work that we have done at the OECD to inform our understanding of the quality of public finances, especially with the view of applying it to the country reviews that we are doing, so that we could get a sense of the recommendations that we are doing in the area of public finance reform, to get an idea of what are their quantitative consequences for economic growth and their implications for the distribution of income. Why are we doing that? Well, a very obvious but still worth reminding reason is that governments are a huge part of our economies. They're about half of our economies. And if you look at the structure of their interventions in the economy, so here the structure of spending in a way that's adjusted for the cycle, well, you see that it's been drifting up first in the first decade of the 21st century under the impact of rising health expenditure mainly, and in the second decade, increasing pension expenditure. So it's been an expansion with some change in structure, but a passive change in structure to a very large extent. And the same thing has happened on the tax side, where revenues have had to follow. They've not always followed, as we know from all the discussions, all the difficulties we have with deficits and debt, but still, to some extent, they've had to follow. But it's been, again, largely a passive change without a drastic evolution in the composition of government revenue. These averages, which are across OECD members, hide enormous differences in the structure of public finances. Here, this is illustrated by one of the most contrasted items, which is public investment. But the same holds even if we look at big items on the revenue side, like personal income taxes and social security contributions, which really have to be looked at together because they are for the most part, taxes on labor. Of course, there is the capital part in personal income tax, but for the largest part, and a lot of social security, a lot of personal. If they are split, it generates sort of artificial differences across countries. But even taken together, they are very different across countries, and it's the same for the taxation of consumption, where in the OECD membership we have countries, with the US and Japan being prominent examples, where consumption is lightly taxed, and others, mostly in Europe, where it is used much more heavily. And our main point is that these differences in the structure, also the size, I will come back to that, but these differences in the structure of spending and tax mixes have implications for economic growth and its distribution across the population. And so actually this project is the second leg of work that we started about 10 years ago, where we looked at these effects in a qualitative way, what is positive, what is negative for growth and inequality. But in this project, we made a big effort to try and quantify as much as possible these impacts. And we did that by using and also building time series of comparable data for tax structure and spending. Actually, on tax structure is relatively easy to do because governments know very well where they are getting their money from. And it's reasonably comparable across countries. I mean, a dollar of or euro of VAT in one country looks very much like a euro VAT in another country, whereas on the spending side, it's much more complicated to gather comparable data, so there had to be work to build it, and then we used panel estimates to quantify the effects. I will not do well on the estimation methodology too long today. The only point I will flag is that this work is purely about the long-term effects. So we filtered out all the cyclical aspects. So the one thing that this work will be totally silent about is any Keynesian effects and differences in Keynesian effects, differences in multipliers across different public finance items. So what I'm presenting today is about outcomes that are happening at a horizon of 5 years or longer. So what do we find when we do this analysis? So we find essentially we have 4 kinds of outcomes. Since we have we have things that can be good or bad for economic growth, and measures, public finance adjustments that can be good or bad for the distribution of income. I mean, good being more equalizing and bad exacerbating inequalities for the distribution of income. And so we have a category of win-win reforms, which at the same time boost long-term economic output and work in the direction of greater economic equality. And that's when you do revenue-neutral reform, where you reduce the effective tax rate, accounting everything, including the withdrawal of benefits on low-income earners, that you finance by a proportional increase in the other forms of taxation, and it's quantitatively quite powerful as well. And another one that has the same characteristic is an increase in inheritance taxes, which allows you to reduce the other sources of revenue. And we did the analysis with data on income. Would probably have even stronger effects in terms of the distribution of wealth, which unfortunately we could not measure for the lack of time series on the wealth distribution. So to give a flavor, we have this kind of charts for all the measures. I will show it only for this one here to give an idea of the kind of quantitative estimates we can have. This is a plot of the long-term change in disposable income that is estimated to happen after the labor tax wage for low-income earners, 33% below average income, has been reduced by 1 percentage point, and the money generated by that has been used to the money needed to fund that has been raised from other taxes. And you see that the people at the bottom benefit more because they benefit from the general positive effect on growth, which comes from greater labor force participation and greater employment at the lower end. So this benefits everybody. But of course, they also benefit more from the fact that their own effective tax rate has been reduced. So they have an extra boost that is visible on the left-hand side of the chart, which are the effects for the lower income deciles. And so we have the same for the other measures. Then we have a bunch of measures which are public finance reforms that we identify as producing positive output effects without significant changes to the income distribution. So they include reallocation towards public investment, in fact, reforms that reduce the rise, slow down the rise in pension spending. In the tax mix shifts towards a greater use of recurring property taxes, or the property taxes that are paid each year, not the transaction taxes on property, and lowering the effective corporate income tax rates. And here, just one word to say that the result that this is positive for growth is really uncontroversial. One that is a little bit more is the fact that we find no systematic effect on the distribution of income, but remember that we look only at long-term effects, and we are looking at OECD economies, which for most of them are very open, and a strand of the recent literature on corporate income taxation is that in open economies where capital mobility is much greater than labor mobility, a lot of the incidence of corporate income tax over time will be on the labor factor. On public investment, one word to say that there are limits to public investment. There are limits, of course, at the micro level. There can be bad projects, but even at the macro level, if you already have a very high capital stock, an aggregate increase in the capital stock does not necessarily generate a positive long-term effect on growth. We find that. And if we look at this region to the lower side, to the right side of the chart, where the effect turns negative, we have actually only one OECD country that is there, which is Japan. And then we have reforms that are more problematic in the sense that they are positive for output in the long term, but they are also generating a more dispersed distribution of income, or, they are benefiting the rich more, to put it differently. But what we find when we put together the output and the distributional effects is that the output effects are stronger, so that when they are combined with the distributional effects, in absolute terms, these changes leave nobody worse off, even if they increase dispersion. But they still come with the difficulties related to this wider income dispersion, and they are changes in the size of government. I will come back to this. All the other detailed reforms are for fixed size of government, fixed spending, fixed revenue with reallocation, but we also look at the effect of government size separately to avoid mixing the two. Another one is reducing public subsidies, because we know that they are often economically distortive, but very often they are there to protect vulnerable groups, and indeed we find that when they are reduced in the long term, they tend to come with lower incomes for the most vulnerable group. And of course, lower net wealth taxes, they will benefit the rich much more than the rest of the population, even if reducing them means reducing a quite important source of distortion, and so something that is positive for the productive potential of economies. One additional word on the size of government, where we find that the size of government does not have a systematic link with long-term economic performance. However, it does when taken together, interacted with the effectiveness of government. Ideally, we would like to measure the effectiveness program by program, spending item by spending item, and it's something I hope that can be done systematically in the future. For now, we have a measure we like, which comes from the World Bank, which is as part of their global governance indicators. They have an indicator of government effectiveness. This was designed more for developing countries, but actually we find it works well also for developed countries. And so it ranks countries here from the left, which is lower perceived effectiveness, to the right, higher perceived effectiveness. You see, and what we find that when this is interacted with the size of government, when effectiveness is very high, a bigger government is not necessarily negative for long-term performance and can even be associated with better performance for the group of Scandinavian countries that you see in the dark blue part of the chart on the right-hand side. And this is to say that we can do the same sort of distributional calculations that I briefly showed before. We can also look at, for the items that have no distributional effects, at long-term effects on the level of GDP. What this chart shows, we'll not comment on all the items, obviously, is that the the spending items, and you see especially investment at the top, tend to have bigger quantitative effects than the tax items that you see more at the bottom of the chart. Something that is not visible on this chart is that the speed of the impact is also greater for taxes. People adjust faster to taxes than spending reforms take time to produce positive benefits. So that if you look at a 10-year horizon, the tax reforms have the same positive effects as the spending reforms. But if you look at longer and longer horizons, then public investment, changes in subsidy programs, pension, which also by definition takes a long time to happen, start producing their effects. Then what does it mean for countries taken in a way one by one? Since we looked at all the items of public spending, what we did was we took public spending, we divided it in meaningful economic categories and tested effects for each of them. Some of them had no effect, which means in a statistical sense, which means we can consider that it's at least in average statistical term equivalent to zero, and others for which we had effects. And same on the tax side, we can take the size and spending structure of countries and see what is the overall effect here on output per capita of the size and structure of government as well as perceived effectiveness, which interacts with size. And so we can build an index, which we did here for this chart, which gives an idea with the contributions from size and effectiveness in green, from the structure of expenditure in pink, and from the structure of taxes in blue. And what comes out of this chart is that in European countries tend to be more to the left side, so with scope for more growth-friendly structure, I mean, scope for improvement, you know, on the left-hand side, whereas the non-European tend to be on the right-hand side, with the exception of the Scandinavians, whom you can see on the right, and whom you can see even more on the right in this chart, which is not looking at the long-term effects on output like before, but on the long-term effects of the structure of public finance on the lower part of the income distribution. And so there, the Scandinavians, they benefit from the combination of well-structured governments plus large transfer programs. So you see a country like Denmark that has moved to the right-hand side of the chart. Then how can this scope for making public finance structure more compatible with growth and equity be used? We know this is difficult in a number of cases because of these trade-offs for some measures between growth and income distribution. Actually, here I chose another trade-off, which is environmental taxes, where we find they are broadly neutral for growth, which is why I did not discuss them before. We find they have a negative distributional impact. This is a heavily contested debate. We find a mild negative distributional impact. However, I mean, they raise money. So this money can be used to cut taxes that fall particularly on the lower part of the income distribution. And when you do that, and if you target a tax like the tax wedge on low-income earners that also has a negative growth effect, you can get benefits that more than offset the negative impact, and we can propose a quantification of that. Then the question is, does this happen in practice? Perhaps we'll come back during the discussion about sort of more negative examples. Actually, there are not so many very clearly positive examples that were designed as such, but a really clean one is a reform that was introduced by the province of British Columbia, where they had a coordinated package of cutting cutting corporate income tax, cutting personal income tax by using revenues generated by a carbon tax. And this was designed as neutral and really presented as such, I mean, neutral in terms of being revenue neutral. actually turned out to have some budgetary cost because the carbon tax worked and reduced emissions, and that there had been no dynamic scoring of the reform. So they lost a bit of revenue, but that was okay from a macro point of view. And what is interesting is that this was a phased-in program over a number of years. And it went to the end of the program. So there was a reasonable degree of political acceptance. Even in this sort of ideal case, it's still difficult to do in the sense that there was a discussion at the end of the program about going further. And the discussion after 2012 was, no, let's stop there. So even when it works well, it is, and well designed, it is complicated. So to wrap up, there is scope for making the structure of public finance more supportive of economic prosperity, including for the most vulnerable groups in the population. I mean, one obvious area, especially in the European context, is public investment, which in many countries has been the target of adjustment because it's an easy way of adjusting spending quickly. Another promising area, this time on the tax side, is to make more use of annual property taxes, which are, an underused source of revenue. And actually, we are doing at the moment at the OECD a big program of work on housing, which also shows additional benefits. I mean, we can, or to put it differently, we can say, perhaps we can say more about where these positive effects for growth come from by looking more closely at what happens in the housing market. Another important area is this effective tax burden for low-income earners, which is actually quite high in a number of countries, including because of income contingent benefits, which are sometimes phased out too quickly so that there are high effective tax rates when income goes up for low-paid workers. One word of warning to finish on value-added taxes, which is important in European context. As part of this project, we looked at whether this, value-added taxes would be one of the good ways to make room for the negative taxes that are identified here, like the effective taxes on labor. And actually what we found that is the case. It's a relatively neutral source of revenue raising. However, we identified a saturation effect, or if you want to put it differently, a Laffer curve for the value added tax rate, and with a maximum which is in the region around 27%. And many European countries, they're not there, but they are sufficiently close to be to this rate, to be in the region where you think there is not a lot to be gained by increasing VAT rates. And at the same time, increasing them will generate increasingly painful distortions. So there are other areas like environmental taxes that should be looked at rather than VAT as a source of adjustment. Thank you very much for your attention.
Thank you very much, Boris. There is a wealth of information here that we're going to need a minute to digest, I think. So perhaps we could ask our discussants to help digest some of this information. May I ask you, Sven, to take the floor first?
I had some slides as well.
Yes, I think the slides will be coming up.
So yeah, first I'll start already. So first of all, thank you very much for organizing this event on quality of public finances, and also thank you for the very interesting presentation with very remarkable results. I think very rich. This event had a rather provocative title, I think. So the subtitle here was, is the quality of fiscal expenses and revenues more important than the budget deficit? This is a question that comes up mainly at a time when deficits and debts are of a bit less of a concern. So the sustainability concerns move a bit to the background. We had quite some work done on the same topic just before the financial crisis, so 2006, 2007. Hopefully that's not a signal of what there is to come now. And coming from the Commission, I first looked at this question from the perspective of fiscal surveillance and what it would mean for fiscal rules. So when discussing with colleagues, I saw it could be interpreted in two ways. Some interpret this question should we allow more lenience on our deficit rules? because if countries take an effort, go through an effort to improve the quality of public finance, maybe that should allow some lenience on the budget. That's one approach, or one way of looking at the question. Another one was, it's all about, if the quality of public finances is important, the member states can do that within their budgetary constraints, so we do not need to be more lenient on the budget, and they can manage within this 50% that they control. In the end, probably there are different objectives and different processes for the deficit and debts, which mainly are about sustainability versus stabilization, and the quality of public finances, which prime objectives are more, as you look at as well, the longer term growth, distribution, greening, well-being effects. There is, of course, some link between the two. There's a growth link, and with that the sustainability link, but the question is this of first order importance or not? So maybe we should keep these processes separate, and both have an interest and a merit in their own right. So I want to raise three questions or issues today. The first one is on, a lot of attention is on the composition of public finances. So on the expenditure side and on the revenue side, and in particular on the expenditure side, we may wonder whether it's really the composition that we want to focus on, and is the composition maybe of second order importance, and is it not more about the efficiency? So more about the how we spend than how much we spend. Second point is, as I'm from the Commission, I will recall a bit how in our work, our coordination processes in the EU, we do look at quality of public finances, what role it plays and what instruments we have, what recommendations we give. And third, I want to very briefly look at public investment in particular. Now, starting first on composition versus efficiency, Boris already mentioned that it's important to look deeper into the details, so that's something that I would like to look at here. There is quite some literature on social and economic outcomes of spending, and it generally doesn't come to very strong or homogeneous conclusions. So the literature is quite diverse. So I think it's a great effort that you made, coming with quite strong conclusions on the composition effects on growth. But generally, they conceal large differences of subcategories of spending. So that's one issue. We should look deeper at micro level. For example, if you look at education, here you looked at education as a whole as an important growth enhancing expenditure. But you may want to look more in detail. For instance, there's the research from Nobel laureate James Heckman, showing that especially early childhood education is the prime expenditure target by which you can really enhance growth and social outcomes. And even when you do that, you may want to look again at micro level. How do you do that? Even there, when you have some evidence, there's still difference on the ways you can do that. Another example is reducing class size is a topic in education, again, that's often looked at and generally is not considered a very efficient in the way you can enhance student achievement. So again, what kind of reforms matter? The country settings matters. The degree of public and private spending in different categories matter. What's the institutional structure, and the quality of governance that you also mentioned is extremely important. So overall, maybe how the money is spent may be much more important than how much is spent. Now this I show for illustration. This is very simple. It's not at all as deep and thorough as the work that you have done, but it gives some illustration of quite large differences with achievements that are made with different degrees of, or different amounts of public expenditure as a share of GDP. What they do with student outcomes. Even more difficult it is looking at outcomes on economic growth or GDP per capita. So this is an intermediate outcome that we look at. It's the PISA scores for educational achievement. So we did this same exercise for education, health, social spending, and looking at a range of different outcome indicators, including growth, subjective well-being, inequality, life expectancy, etc., and looking at spending as a share of GDP and spending per capita. And overall, for all these exercises, they show very similar results. So what the main message to me is of this is there seemed to be quite some scope for improving efficiency or effectiveness of measures. If you compare across countries, take Cyprus or Denmark, both spending 5% of GDP on education, both could increase efficiency by moving to the left, spending much less, achieving the same outcomes. It's very simplistic analysis, but it does give some signal. Maybe what do other countries do better? And the same, they can, with the same spending, many member states could maybe achieve higher outcomes. So the effectiveness could be improved. So combining this simple graph with the findings in the broad literature, it may indicate that better outcomes are often possible with the same expenditure by spending better rather than more on some of these expenditure items. So second point I wanted to address is the EU surveillance context. In the process for coordinating national economic policies, we have the process called the European semester. It's one of our main tools, and it also is used to improve the quality of public finances. And over the years, we've addressed many recommendations to member states. And it's not a coincidence, maybe, that the measures that are listed here as the ones that are most often shared with member states, to quite a degree, coincide with what you found as win-win measures, and especially on the tax side, where you also said it may be easier to analyze on the tax side. The findings may be easier than on the expenditure side. So here's just a list of the issues that Boris just mentioned before as well: lowering the tax burden on labor, reducing the tax wedge for low-wage earners. In addition, broadening tax base, improving tax compliance, again, making use of lessons learned by other member states, applying best practices. And on the expenditure side, for some member states, indeed, we stress the importance of safeguarding growth-enhancing expenditure, despite caveats there are. But then it may be, if there's a lot of pressure on these expenditure items, this is signaled in these member states. And in addition, increasing the effectiveness of public spending, including by recommending spending reviews. Now, one concern we have here that may come up at the end or in the discussion as well is that implementation of the recommendations is rather poor. Question is also, why is it poor if many of them are win-win? And yeah, so that's an issue that we should look into more deeply. Now, a quick look at investments. As there was a dramatic fall in investments since the crisis, and it has not recovered, and is so still well below pre-crisis levels. If you look at, say, the net fixed capital formation in the euro area, it's close to zero. So that is some cause for concern, as it not only is important for potential growth and competitiveness, it also is one of the drivers for demand in the recovery. And another aspect of quality of public finances that's not often discussed is the budgetary flexibility. Increasingly, many budgetary items that are more flexible and discretionary are being replaced by items that cannot easily be reduced or adjusted because they are explicit or implicit entitlements. So you get budgets may increasingly move towards more entitlement-based spending, implicit or explicit, so pensions, social expenditure, very difficult to adjust, and with that having an impact on sustainability of public finances. What can be done about the low investment? European fiscal boards and many academics are just, for instance, introducing some fiscal golden rule in surveillance, but we know there are many caveats, very, very tricky, very difficult to introduce in practice. Now I end with some questions. Much of the quality of public finance analysis is on the macro composition of expenditure. Probably we should focus more on efficiency, looking more at micro aspects, looking at spending reviews, and maybe also making more use of increasing available micro data, new methods, stronger evidence on what works in terms of reforms. As I said, the implementation is disappointing, and how to bring on board crucial stakeholders is a question here. How to engage in a real dialogue based on evidence. Some examples are, it may be to do with institutions at national level, institutions at EU level. Example is in the Netherlands, the Central Planning Bureau, for instance, publishes promising policies analysis. So they have a comprehensive set in a specific expenditure category, so education. They make an overview of existing evidence and research of a certain quality based on microdata, microanalysis, and then they give policymakers an overview of how effective it is, what the trade-offs are, etc. So that gives an overall basis and a policy choice to policymakers based on very strong evidence. I also think the OECD approach is very important, where they look at distribution combined with the economic effects, again allowing identifying win-wins where possible, and allowing seeing trade-offs where possible as well. So that's another very useful step forward. Last element or last questions are on environmental taxes. They will be important, increasingly important in the years ahead. How do we deal with the emission reduction? Most efficient is probably carbon pricing, but there may be important trade-offs. But maybe they're not so important as Boris just said. But there may be trade-offs and how to deal with them. Well, in the presentation by Boris, he said it should be combined with cuts in effective taxes on low-income labor. Should it be low-income labor or more just low incomes? Then you deal with all kinds of new trade-offs between making work pay, unemployment trap, in-work poverty trap. Where do you increase the marginal tax rate? So maybe overall, I say there are many more questions for discussion on this very interesting topic.
Yeah, thank you, Sven. I don't think you've narrowed down the information that we received from Boris earlier on, but they all are very interesting questions. But let me just take perhaps Francesco's comments as well, and then we can come back to discussion.
Well, thank you very much. I must admit that the first time I was really exposed to this qualitative public finance, I was a bit like St. Paul on the way to Damascus. I mean, I was struck by this because I was very much concentrated on the usual quantitative issue. I mean, what is a deficit? What is a level of debt? And of course, I knew that there was something behind that, but I never really paid much attention, nor did I realize that you can go much beyond saying, yes, it matters. I mean, you can measure the way it matters. You can measure the consequences, or one or the other way, of composing public finance. So I have some analytical questions and I have some policy question on this issue of public finance. I mean, if you, like me, listen every 8 times a year to what the president of the ECB has to say in his press conference, you would realize that he always mentioned to look at the composition of public finance to find out ways to foster growth without touching on the balance and without touching on the deficit. So he stresses this point of qualitative public finance, even if he doesn't call it that way. And yes, I mean, this looks sensible. I mean, when you listen to him, yeah, he must have a point. But then you ask, what is the empirical evidence about this? I mean, is it strong? And what I found in the presentation based on the OECD material, which is consistent with what you said, is that the empirical evidence is quite strong. I mean, there is quite a lot that you can do by working on the composition. And then there is a question of the efficiency, which is the next step. But already working on the composition, you can do quite a lot. And what is even more interesting in a way is that you can do a lot not only on growth, as Draghi says, but also on inequality. And even if environment and climate are not the emphasis in the OECD studies, there is something about green. So, okay, you have a tool that can do something on growth, can do something on inequality, can do something for the climate. That seems to be, what you could dream of in your best dream. And then there is the question of, can you go beyond the composition to the efficacy, effectiveness? So yes, it's one important step to look at the composition. The next step, which is probably empirically much more difficult, much more complicated, is not to look only at how much you spend on education, but which is the effect of education, how effective is education or investment or health or whatever other item on the revenue or tax or expenses side of public finance. So I think that the theoretical and empirical foundation of qualitative fiscal policy are robust. So it's not only promising, but we do have elements to say, well, yes, we have something here on which we can work. And we heard something from Boris about how the estimates of this famous Laffer curve fit into the discussion about qualitative fiscal policy. And my understanding is that this is too rough a way to look at public finance to really address the issue of you have to take that into account, but that is really a very first approach to qualitative public finance. So these are my analytical questions. These are my economic policy question. There seems to be a lack of attention in discussions at all levels, public opinion, government, academia, a lack of attention to this qualitative aspect of public policy and an over-concentration on the quantitative side. So my answer to the question is, would a shift from the quantity to the quality be justified? Yes, in red and strong point. Then we come to a more difficult issue. Public acceptance of qualitative public finance. When you really have to tell people, no, I'm sorry, you cannot have more of this, and you can have less of this, and you have to pay more taxes here. It seems that qualitative public finance meets more hurdles than quantitative. And I understand that British Columbia is an interesting case, but this is a province in Canada. So we are not talking about a large sample of countries that manage to do these kind of things. So is it more difficult from some economic policy point of view? Then the other question is whether this qualitative public finance is and should remain a purely national issue, or whether there is some role for international organization. And I understand, also following up on the EU experience, that the success is at best mixed. But on the other hand, if you look at some of the charts of Boris, where you see the huge disparity between countries, I mean, from the worst to the best, you realize that there is an enormous opportunity for everybody trying to move towards the efficiency frontier. And you would think that the role of international institutions there would be crucial, would be critical in helping countries do what is good for themselves. My last point is, of course, we know that the attempt to guide the quantitative fiscal policy in the euro area by means of rules is, what word should I use? Complicated, to say the least. I would not belong to those who say that this has been a failure, because it has not been a total failure, but it has not been a success either. So we start from mixed situation as far as rules for quantitative public finance. The question is it possible to have rules in qualitative public finance, or we just have to say, well, no, structured discretion is the only way to go. So one question is national versus international, and the other is rule-based versus discretionary, even if structured discretionary approach. So these are my questions. I also try to extract from the two presentations some answers to my question. And the one message I would reinforce is, yes, we have to do more on qualitative public finance.
Great, thank you very much, Francesco. Boris, would you like to take a few comments from what you've heard, and then we have a little dialogue between us, and then we open up the floor?
With pleasure, yes. Thank you very much for the appreciation and all the insights. I wanted to pick up on a few points, on the point that Sven mentioned, that things are clearer on the tax side. I would say yes, it's definitely the case. Actually, from a technical point of view, we see this, that when we estimate the effects with the confidence bands, these confidence bands are narrower for the tax side. And I think it's related to this fact that taxes look more alike across countries than spending programs do, which indeed leads to what happens within programs. And here a key area is education, indeed. When we apply this approach that I've presented before, we find no link between how much countries spend on education and the long-term economic performance or inequality. Actually, we tried something else, which I did not report, which is that we look at PISA scores and years of education. When we do that, we find that, yes, if we take PISA scores together with the average number of years of education, there is some link with long-term economic performance, which means that what matters there is not really how much money goes into the machine, but what is the quality that goes out of the spending programs. This is, you will have to qualify, this is something that holds for OECD and EU countries. If we look at lower income levels, if we go below the levels of education spending that you have in countries like Portugal, Greece, if you go below to the middle income countries and a fortiori to the low income countries, there you have a very tight link between how much countries spend on education and the scores of the education systems on quality measures. So there is a link up to a point, but our advanced countries are beyond that link and in the area where the quality of programs matter more. Which then there is a last point on which I would like to say a few words, which is, this question as to if there are win-win options, why don't see we more of this happening? and it is also related to this question about granularity. And for me, an example of that is comparing this British Columbia reform that we talked about before with the set of measures that the French government took, when was it, 2 years ago. If you look at them, they were not so different. France was reducing corporate income tax. It was reducing social security contributions, and especially the ones that fall on lower income earners. And a good chunk of that was funded by an increase in fuel taxes. So if you put the bullet points for that, they don't look very different from the bullet points for British Columbia. However, what was, and the difference is that, I mean, it was not acceptance. What happened was the Gilets jaunes movement and a lot of backtracking, and probably the case for environmental taxes has been damaged for a long time in the French policy discussions. So what was the difference between the two? Well, technically, one was that it was not simultaneous, because in the initial plan, the cut in social security contribution was gradual, was due to occur over time. Perhaps more importantly, it was really not announced as a package. The tax cuts measures were announced first, and then there was a recognition that there was a budget hole that has to be filled, and fuel taxes were picked. And then that's where the first area where we need to get more granular to understand what happens is that it was an increase in fuel taxes and not a carbon tax. In the sense that I should be more precise, it was an increase mostly on motor fuel taxes, which are already sort of the items that, in terms of carbon taxation, are the most taxed, and that was including a lot of other emissions that were not covered, whereas the British Columbia carbon tax was a true carbon tax. All sources of emission of CO2 were covered, so that includes heating oil, these kind of things. And then another source of difficulty, which probably is more in a way more challenging, because the ones I mentioned before were more about design and communication. The one that is probably more challenging is that when we do our analysis, we look at what happens to low-income earners, and we find that indeed, if we package, for instance, higher environmental taxes with lower taxation of low-income earners, all groups are better off. But if we look within these groups, we'll still see differences. And that will be between urban and rural poor people. That if you do a move like this, the people who have more use of motor fuels, who live in the land, a number of them will still be net losers within this group of people who are in the first 2 quintiles of the income distribution, whereas the urban poor, who can rely on public transportation, will get the full benefit of the lower income tax without having the motor fuel offset. And indeed, if we look at the geography of what happened in France with the Gilets jaunes movement, it was very much that. It was not an urban movement. It was not about the banlieue. It was really about the countryside. So that in practice, this kind of tricky questions arise and have to be dealt with by packages that are even, more carefully designed at a more granular level than just these big items.
I was wondering if I could probably chip in the conversation. It's very difficult to disagree with what you said there, Francesco, that the quality of public finances really is something we should pay attention to. How much we get for one euro we spend, it's an important thing. But the implementability of this is actually a challenge. We might actually shift the discussion towards more quantitative rules like the ones we are following, simply because they're a lot easier to monitor and a lot more, they don't have the discretion that the qualitative finance requires. But there was some interesting, since Sven, you brought up the education graph, which I thought was extremely telling in this respect. I wonder what to make of it. There was 2 countries that I sort of picked up, which you had Bulgaria and Cyprus, which achieved the same PISA score. but Cyprus spent twice as much to get to that effect, right? So, you can, by looking at this graph, you can say that there is efficiency gains here. You can achieve the same results in PISA scores if you were to sort of half your expenditure. But is that correct? I mean, the efficiency frontiers that I think you brought it up, Francesco, is an important thing, and it cannot be a general efficiency frontier. Cultural aspects, systems matter. And in fact, if I wanted to be provocative, Cyprus is one of the richest countries in Europe. So if you were simply to correlate expenditure and education and growth, so the level of welfare, you have huge gains there by bypassing PISA scores, right? Whereas Bulgaria, which is one of the poorest countries, spends also much less. That's actually what matters at the end. The result is actually welfare, and the PISA score is an intermediate step. I'm being provocative here, so for the sake of argument. So at the end of the day, how do you define efficiency frontiers? Right? You can take this to example because I think that's an important one. Cyprus is going to be one of the richest countries here, spends a lot on education, happens to do rather poorly in terms of the PISA scores, but actually achieves very good welfare as a result. So, where is the efficiency frontier? And, it is multidimensional, the efficiency frontier, and it will be very different, I think, from country to country. And while I'm that, I also wanted to raise a question about the definition of what you mean. So a win-win reform, right? Because, you're quite clear about the fact that a reform that reduces inequality is a good thing. But you don't do this intergenerationally. You do this within generations, right? If you were to put in the sustainability argument, then you start bringing in inequalities across generations, which I think are, or fairness across generations, if you like, which I think is a very important argument when it comes to public finances, because you are either front-loading or you're pushing to the future expenditure items that produce certain outcomes. And of course, in your exercise, you don't take into account short-term effects, right? But short-term effects are really what are going to make or break the implementability of these measures, because they happen to be implemented at a very high discount factor. So all these types of difficulties, the worth of the argument notwithstanding, is actually, I wonder how easy it is to implement these things and actually see visible differences.
Yeah, that's for me. Yes. On the latter, the short-term effects. Yes, they can be. They can be obstacles. Sometimes they can work on the positive side. For instance, public investment, making. Shifting spending towards public investment. This is one area where the short-term effects should work in the positive side. That you would have really even bigger effects, positive effects in the short term than the long term, since most of the literature on Keynesian multipliers finds that within spending, it's the area that has the biggest demand effect. So there. That is an area where there is support. On the tax reforms like tax cuts for the poor, finance, for instance, by VAT increase. This is also not too bad from a short-term perspective. You also have employment effects that will come in support. However, as I said before, the problem is that this is sort of measures that are available mostly in non-European countries, in the sense that in Europe, the room for increasing the VAT rate is largely used in most countries. What remains in Europe is more broadening the tax base for VAT, but that is also kind of worms from an implementation point of view, because broadening the tax base, that means taking away or reducing the VAT exemptions, but these VAT exemptions have very strong constituencies defending them. On the intergenerational point, yes, our analysis is not informing this debate. That is absolutely the case, and it is one area where surely also the question of not only the quality but the quantity of public finance comes back, because then the question of debt becomes a huge one for intergenerational fairness, which is why, in particular, when we take the results of our empirical work to the policy debate, the area where we are most cautious is pension, where we will tend to draw also from a lot of other analysis, because, I mean, anything said on pensions has to take into account the intergenerational aspect as well. On the empirical basis, well, thank you for the comment, and I would like to say that it's we have a lot of quantitative results here, and that's what we wanted, because we wanted to be capable of providing concrete support when we have discussions with countries in the context of our country reviews, and countries would like to know what kind of benefits they can expect from reforms they are planning. However, this is not the only source of confidence we have in the direction of the results, that all the results were cross-checked with the literature in the relevant area, because I mean, one has to be careful with any single empirical exercise before taking it to the policy debate. And the big question that Francesco raised about the role for international organizations, how can we push? I'm convinced we can do it really by this transfer of experiences, in addition to this cross-country evidence that we have been putting on the table. In an OECD context, it is reasonably straightforward, in the sense that we have a peer review process. We have recommendations that are really made for the benefit of our member countries, but we are nudging institutions. Then countries, I mean, we have there are no legal mechanisms in the economic area to force implementation, so that facilitates the dialogue. If it, it's indeed a very difficult subject to put in more enforcement kind of mechanism. Starting with the measurement, we know that even for the aggregate numbers, measurement is difficult, but here measurement is really tricky, and I mean, there is a practical aspect of the work we did that illustrates that to build this database on the spending side. In a number of cases, we really had to do work to reclassify from one country to another to make sure things were comparable. And so that means that if these items become too close to hard targets, then the potential for reclassifying is relatively high. So there has to, or to put it in other terms, I think there is a lot of support that can be brought internationally, especially by transfer of experience. But for this kind of measures, which are really close to people, there has to be a good degree of national buy-in for this to happen.
Absolutely. Sven, did you have any comments? And Francesco, any quick comments before we come to the audience?
Maybe one more. I think if you look at the debate and the questions that were raised, they all, to me, point in the same direction, that we should look more disaggregated, micro-analysis, assessing losers across many different dimensions. So you already looked at income deciles. You raised the time dimension, short-term, longer-term, the geographic dimension. So there are many dimensions to look at. We need to look more disaggregated, case by case. The same for the question on the spending versus intermediate outcomes, final outcomes. We need to understand much better what's behind. So in all, to me, that leads to think about the questions that you raised. If we need to look on a country-by-country basis, or the qualitative measure, looking deeper, there's a heterogeneous setting, makes it very difficult to come up with rules, and leads to think of the policy context to have softer coordination tools, learning from best practices. Maybe the one thing that you raised as well is it's not enough in the debate, in the public debate. That may be something on which we can do much more.
Francesco, any comments?
Well, no, I mean, I think I would leave the floor. Just, I mean, Sven insisted on going one step further, not looking just how much you spend, but also the effectiveness. Your kind of quantitative exercise, could it be done by increasing this further refinement, or you would have to move from a more quantitative to a more qualitative kind of, which would mean somehow a loss of precision. I mean, if you would rewrite this paper following Sven's suggestion, could you take into account the effectiveness of the spending and not only the size of the spending?
It has to be done differently in the sense because what we cannot do, actually we did was we take the spending areas we have and we split them into subcategories and we try to do the same exercise. Actually, there the cross-country comparability problems really become way too big. We cannot do that. So to go more granular, the approach has to be different and it has to be something that is not unified across spending programs, but specific. It will have to be one exercise for education, one exercise for health, maybe one exercise for civil justice, and so on, because there really the structures are different, the sources of efficiency and inefficiency will be different. And picking up on the point you made about the efficiency frontier in education, is, for instance, I think in practice what could be done is to look maybe not at the absolute level of spending and look at the efficiency frontier with PISA score, but do things like look at how much is spent relative to the level of income in the country. Yeah. To avoid this problem, because it's what, when you look at the chart and the efficiency frontier, the richest countries, they tend to be inside because of this phenomenon, even if there are some interesting exceptions. I remember from the chart that Germany was on the frontier, even if it's a high-income country, which suggests there are probably things that are done right in Germany after the wake-up call of that were done right after the wake-up call of PISA in the early 2000s.
Wonderful, thank you very much. Well, why don't we then just open up the floor for questions from our public? Could we have the microphone, please? So we had two questions here, one at the back and here on the front as well. Could you introduce yourself? And yeah. So it's on. Yeah.
I'm lecturer at the University of Brussels, and in an earlier life I've worked in the Commission on those issues as head of unit in DG taxation and was involved also in the European semester. I had two questions. One, as you mentioned, VAT and VAT rates. You have mentioned in the discussion the exemptions of VAT, but you also have the VAT reduced rates, which and there is a lot of literature that shows that VAT reduced rates is a very poor instrument to redistribute income, and in some member states you could get a lot of additional revenues by phasing these reduced rates out. And I wanted also to draw the attention to environmentally harmful tax incentives and subsidies. It's not only a question of increasing environmental taxation, but the first step would already be to phase out these harmful subsidies and tax incentives. And you have, I think, an example that should be well known in this room is the company car taxation in Belgium. And that is, I think, an interesting example, because the Commission has, since years, and also the OECD probably as well, recommended to phase this distortionary system out. Also, the Bureau du Plan, for instance, has worked on this in Belgium. So far, to little avail, and simply because politicians have understood that the voters are extremely eager to keep the company cars, even to sit in the traffic jams with them, and are afraid to rectify this, although it is something that has a sizable macroeconomic welfare loss, and a lot of revenues could be also found in rectifying this. And I think it's an illustration of the problem is why does it not work, or not to the extent that we would wish. It's because of political economy factors that block sensible decisions from being adopted and implemented.
Thank you. There was a question here from Lars, and then one at the back.
Thank you. Lars Hogarth, formerly with the Commission, now with consultancy TradeUp. Thanks for the presentation. I think it was very good that we start this kind of a discussion, but it does lead me to the observation that unfortunately we didn't have that kind of discussion when the Stability and Growth Pact was put together, because the Stability and Growth Pact, as to quote a former Commission president, is stupid in the sense that it completely ignored what kind of expenditure, what kind of revenues that we were talking about, just had these absolute figures on debt and deficits. So now in an environment with low interest rates or zero, even negative interest rates, the argument has been always that with a deficit and with debt burdens, this would be a burden on future generations. But in an environment where we are now, future generations would be legitimately criticizing us for not undertaking growth-enhancing types of investments, even if that did lead to a exceeding of the 3% deficit or whatever rule we have. Because the growth-enhancing investments, whether it be bridges or highways or research and development or education or whatever, means that the cake is larger in the future, and with inflation, the payback is lessened. So future generations would say, you had the Stability and Growth Pact, but you missed the train. You should have done quite the contrary. You should have increased expenditure, and especially the quality of it. And I think in that connection, it's unfortunate that we haven't had that discussion before, but now, if we can have it, it makes a lot of sense. The point is really then, can you agree amongst the Eurozone and within the EU, what is a quality investment? Does it prove to be growth enhancing, what you're spending money on? And you can have quite a fierce argument about that. But as long as you have the dogmas of schwarze Null, for example, in Germany hanging around, it completely blocks for that kind of constructive discussion. So I think that's a way forward. Just one observation. Corporate taxes. This is now being discussed also in the OECD. And there was this conference the other day where a Swedish analysis was made by which, in principle, corporate taxes should be zero, because it reduces the profits, it reduces the capital base, it reduces thereby the investments that a company would otherwise undertake. It puts pressure on wages in that company. It can't afford to pay as much as it otherwise would be. So it's negative. Basically, that's the concept. Corporate taxes are negative on growth. I would like to hear your views on that, because that's quite provocative.
It is, yeah.
In the sense that maybe the cake would be at least as big or bigger, but how do you ensure that the distribution of taxation on the rest of the population, and in particular the low-income population, is assured so that it doesn't increase inequality by that kind of thing? Thank you.
Thank you, Lars. Let's take the last question there on the back.
Thank you, Benedict Madel from DG DEFCO. I was wondering on the definition of quality in public finance. I mean, we work a lot with partner countries on public finance management, PFAS, and looking at the administration, and obviously there's also lots of qualitative issues there, but it relates to the administration, all the losses you do in bad procurement, etc. So, I mean, but what I understand is that in all that analysis, you don't look at all at that, but you simply look at the policy side. But on the other hand, when President Draghi speaks about, you know, improvements in public finance, he might as well refer to that administrative side where you actually also can gain a lot and reduce costs on the one side, or have more efficiency in spending on the other side. So what is actually your, I mean, what is the definition? And I mean, obviously it would be different from the spending and from the revenue side. Thanks.
Could we come back to you, Boris? This is a very specific question, if you can want to take that, but the others are a bit more general. We can involve everyone in the panel.
Yes, maybe, yeah, this one, to some extent, we pick up with the measure of effectiveness, even if it's perceived, it's by the people who are benefiting from the government services. Actually, we try to look at it by using other World Bank indicators about quality of administration, etc., but they are highly correlated, so it's difficult to distinguish, and they all capture the same thing. Actually, to do this properly, and that would be part of this agenda for the future at looking within sectors. I think when we talked before about education and health, these items, but when we talk about investment and also general administration, if we want to look at the quality of investment, we have to look at the procedures that are in place to manage it, to screen the investments, to manage the projects when they are being developed, and to evaluate ex post. And the same for general administration. If we want to look at the effectiveness of general administration, we have to look at what are the procedures in place. And there is a quantitative agenda there that is still to be picked up about building or even using some of the indicators of how public sectors are managed, because there are more and more indicators that are done. We do some at the OECD. The Hertie School in Berlin is doing some. There are others. And relating these to measures of performance. But yeah, this... I mean, I agree this is important, and it's probably where we have to go for the future to bring this debate forward. Here we just, to some extent, we touched it through the angle of effectiveness as perceived by people in the survey indicators of the World Bank, which is interesting, but is outcome indicator. So it will be interesting to see what are the policy levers that make this outcome move.
And do you think that corporate taxes need to be at zero?
Well, that's...
and remain revenue neutral?
Remain revenue neutral. Well, there is... I mean, it's a tax that generates distortion. We find, indeed, in our analysis that higher corporate effective tax rates are associated with lower long-term economic performance. However, this is estimated in a sample where, I mean, we don't go all the way to zero, so we should be careful. This is true around the historical average of our sample, which also was higher than the levels we have now, because we've been a lot of cuts in corporate effective tax rate. So, I mean, there is a lot of literature about the negative effects of the corporate income tax. There is also, it is true, a lot of technological and policy advances that bring other ways of taxing capital income. I mean, on the technological side, the better tracking of payments, transfers has allowed a better way for tax authorities to follow capital income, and that has been accompanied by a lot of agreements on automatic exchange of information. So there is scope for personal income tax to better tax capital income. So So this is all the case for lower corporate income taxes, but this will never be to zero. I mean, zero cannot be the optimum because there are also a lot of economic arguments for keeping corporate income tax at the. I mean, the most basic one is this idea of having a withholding tax on capital income gains to avoid leakage. I think more sophisticated is the argument that there are a lot of small and medium-sized firms where it is very difficult to distinguish between what is spent by the firm and what is spent by the individual or the individuals running the firm. And so the capital income tax rate as zero would open huge possibilities for tax evasion, even in a world where capital income would be perfectly taxed when it is paid to the capital factor. So to me, these studies that come with the recommendation zero capital income tax rate, I mean, I understand their logic, but I think it's a case of pushing a logic to an extreme where it does not apply anymore because it is omitting other factors which become increasingly acute when you reduce tax rates.
Francesco, any comments?
I would like to touch again on this issue of the possible, I mean, you raised that and was mentioned again by that gentleman, about the interactions between quantitative and qualitative. I mean, you said two schools of thought. One is, well, since you're doing the right things on the qualitative side, we give you more leeway on the quantitative. And the other, opposite, is, well, since you have a lot of room to do things on the qualitative side, don't bother me with asking for leniency on the quantitative side. And there was this reference to the Schwarz Null. And my point of departure, and of course I'm willing to change my mind if I'm convinced, but my point of departure is that separating the two issues would be useful. So you think what is best to do on the quantitative side, counter-cyclical policy, yes, counter-cyclical policy, not, sustainability of debt, and all these things that we know very well. And then you have an issue of how you spend and get revenue, and you don't mix the two. I mean, these are two different exercises, as I tried to say, and I think that this is coming. One is overemphasized, and the other is sort of a bit neglected. But I would keep them separate. So maybe we need counter-cyclical policies in Europe, yes, but that's another discussion. In the meantime, let's improve on the way we spend the money.
Thank you, Francesco. Sven, any?
Yeah, I would agree with that. On maybe something else on the. You said the pact was called too stupid. Now we're a bit more concerned that it's too smart, because it's got so many rules now that the complexity is an issue, not the simplicity. The other aspect of that is you mentioned the decline in interest rate. With that as an argument, also on that, the pact is a bit smarter than perceived, as this decline in interest rates gives fiscal space in primary expenditure. So, for instance, Belgium has got 4% more fiscal space now than it did in 1999 in primary expenditure, which is the relevant thing if you think about investments. And on the rest, why to keep them separate? If you have 50% of GDP in which you can decide what to use for growth and for social or other expenditure, maybe that should be sufficient, and we should not worry about 0.5% extra or 1% extra there. That said, the Schwarze Null is not an element of the EU rules, and we do encourage countries with fiscal space, like Germany and the Netherlands, to invest more and to spend more. I wanted to also just come back to the question on the politics that are not easy. The company car example, which is a very interesting one, because it leads to less revenues, it distorts, it is not green and not social. So bad on all fronts. And then still, there's something in politics that does not allow you to change it. A similar example when I worked on Ireland was children's shoes. It's not as bad for the environment, but there was low taxation on children's clothes and children's shoes. In the end, if you looked in the shops, then the children sizes went up to 40 for the shoes or larger. The clothes also for the children became larger and larger. And you know that there is an issue that distorts, but governments did not dare to touch it because one government had tried and had fallen on it. So then it becomes a no-go, a taboo. So how to address these type of things? It's challenging. I think on the green-brown thing there may be something to do if we manage at measuring, creating some measures, a monitoring system for greenness or brownness of the taxation system, and then allow comparing countries, and then they find some targets or references that may help in this type of debate.
Wonderful. Boris, any last word? We have 1 minute.
Just to say, agree with the point raised on the reduced rates of VAT. They're a terrible instrument to protect the purchasing power of the poor, in the sense that it works in the sense that they benefit from it, but the deadweight cost of doing it is enormous, because in terms of the amount of money, most of the money that is foregone because of these reduced rates is money that is spent by the higher income groups. So it would be much more efficient to do this kind of purchasing power protection for the poor through other instruments. But I didn't know the Irish shoe example, and I think it's a wonderful illustration of the political difficulty of improving the quality of public finances. And I'm happy to end on this note, and with a big thank you to everybody, Indeed. To you and to everybody in the audience for this.
Thank you very much for coming. Thank you. I hope we'll have an opportunity to discuss this topic again in the future. But for the moment, please join me in thanking the panelists. Thank you all for a very interesting presentation.